Question 1. Topic: Financial aspects of captive insurance. A newly formed captive insurance company in Arkansas is analyzing its financial position to meet statutory requirements. It needs to ensure it maintains adequate capital and surplus to fulfill regulatory obligations. Which of the following best describes the reason why the Arkansas Department of Insurance requires captives to maintain these financial reserves? A. To allow captives to maximize investment returns by holding substantial reserves. B. To provide a buffer against potential underfunding of claims and ensure solvency. C. To enable the captive to pay dividends to its owners. D. To ensure that captives adhere to federal tax requirements. Answer: B. Explanation. The Arkansas Department of Insurance mandates that captive insurers maintain specific capital and surplus levels primarily to ensure they have adequate funds to cover potential claims, which is essential for solvency. This regulatory requirement acts as a financial safeguard to protect the captive's policyholders, ensuring that it remains solvent and can meet its obligations even under adverse conditions. Unlike option A, the focus of capital reserves isn't on investment returns, but rather on financial stability. Option C is incorrect because dividends are secondary to meeting claims obligations. Option D is incorrect because tax requirements are separate from state solvency regulations. Question 2. Topic: Corporate governance and compliance for captive insurance. Sarah, a newly appointed board member for a captive insurance company domiciled in Arkansas, wants to understand her fiduciary responsibilities to the captive and its policyholders. Which of the following actions would best align with her fiduciary duty in this governance role? A. Seeking board approval to maximize investment profits by shifting all assets to a high-risk portfolio. B. Proposing a compliance review to ensure adherence to Arkansas's captive regulatory requirements. C. Reducing financial reserves to allocate more funds to premium reductions for policyholders. D. Encouraging the company to avoid reporting smaller losses to improve its financial image. Answer: B. Explanation. A board member's fiduciary duty includes safeguarding the company's long-term viability and ensuring regulatory compliance. Proposing a compliance review, option B, aligns with these responsibilities as it helps maintain adherence to Arkansas's captive insurance laws, thereby protecting policyholders and the company's reputation. Option A is incorrect as it exposes the captive to excessive risk, contrary to the board's role in risk oversight. Option C is incorrect because reducing financial reserves could compromise the captive's solvency and ability to meet claim obligations. Option D is inappropriate as it involves ethical and potentially legal violations by obscuring financial transparency. Question 3. Scenario-based. Topic: Reinsurance and alternative risk transfer. John owns a mid-sized manufacturing company and is considering forming a captive insurance company in Arkansas to better manage his company's risks. He learns that reinsurance could play a significant role in stabilizing his captive's financial position. If John decides to use reinsurance, what primary benefit would this arrangement provide for his captive? It would allow the captive to avoid all regulatory requirements in Arkansas. B. It would enable the captive to transfer part of its risk to another insurer, reducing potential financial strain from large claims. C. It would reduce the need for John's captive to hold any financial reserves. D. It would allow the captive to increase policyholder premium rates without justification. Answer: B. Explanation. Reinsurance serves as a risk management tool by allowing a captive to transfer a portion of its risks to a reinsurer, which is especially beneficial for managing exposure to large claims. This risk transfer stabilizes the captive's financial position and can reduce volatility in claim payments, enhancing the captive's overall solvency. Option A is incorrect as reinsurance does not eliminate regulatory obligations in Arkansas. Option C is also incorrect because captives are still required to maintain reserves regardless of reinsurance. Option D is inaccurate, but reinsurance does not justify arbitrary premium increases as premiums must reflect actual risk and regulatory guidelines. Question 4. Topic: Risk management and risk retention for captive insurance. A captive insurance company in Arkansas is assessing its risk retention strategy. Which of the following best describes why the company might set a high retention level for certain risks? A. To avoid paying reinsurance premiums and reduce operating expenses. B. To ensure that all risks are fully transferred to third-party insurers. C. To increase the likelihood of profit-sharing agreements with reinsurers. D. To have more control over its risk exposures and potentially reduce claims costs over time. Answer: D. Explanation. Setting a high retention level allows a captive insurance company to retain control over its risks and manage them more directly, which can reduce claims costs and improve the captive's loss experience. This strategy also enables the captive to customize its risk management practices according to its specific needs. Option A is partly accurate but overlooks the broader risk management goal. Option B is incorrect because high retention implies keeping more risk, not transferring it. Option C is incorrect, as profit-sharing agreements are generally not a primary objective of high retention. Question 5. Topic: Captive insurance policies and coverage types. Which of the following coverage types is most commonly tailored by captive insurers to meet the specific needs of the insured entity? A. Standardized auto insurance. B. Homeowners insurance. C. General liability insurance. D. Life insurance. Answer: C. Explanation. Captive insurers often customize general liability insurance to match the unique risk profile of the insured entity. This flexibility allows the captive to address specific operational risks that traditional insurers might not cover comprehensively. Standard auto insurance, option A, and homeowners insurance, option B, are typically offered through the conventional insurance market. Option D, life insurance, is less common as a primary product for captives due to its unique regulatory and financial requirements. Question 6. Topic: Corporate governance and compliance for captive insurance. In Arkansas, what is a primary role of the board of directors for a captive insurance company? A. To directly manage day-to-day underwriting and claims. B. To provide governance and oversight while ensuring regulatory compliance. C. To exclusively set premium rates for the captive's policies. D. To handle direct client relationships and manage policyholder inquiries. Answer: B. Explanation. The board of directors for a captive insurance company is responsible for governance and oversight, ensuring the company adheres to all relevant laws and regulations, especially those specific to Arkansas's insurance code. This role involves high-level decision-making and compliance oversight rather than direct management tasks. Option A is incorrect, as operational tasks like underwriting and claims handling are typically managed by executives or third-party administrators. Option C is incorrect, as premium setting involves actuarial input. Option D is also incorrect, since client management is usually handled by specific administrative roles. Question 7. Scenario-based. Topic: Formation and operation of captive insurance companies. David, the CFO of a large corporation, is tasked with evaluating whether a captive insurance company is a feasible option for their business. His initial steps include conducting a feasibility study and drafting a business plan. Based on these preliminary steps, what should David primarily assess to ensure a successful captive formation? A. Determine the maximum premium that policyholders can afford. B. Identify the risks that are financially viable to retain and those needing reinsurance. C. Establish a detailed marketing plan to attract external policyholders. D. Focus on minimizing regulatory compliance costs in all jurisdictions. Answer: B. Explanation. Assessing which risks to retain versus transfer through reinsurance is a key step in the feasibility study for captive formation. This assessment ensures the captive will have a financially sustainable structure while managing the risks effectively. Option A is less relevant, as captive premiums are typically determined based on the parent company's risks. Option C is incorrect. Most captives are formed to cover specific risks of the parent company, not to attract external clients. Option D is also incorrect, as regulatory compliance is a mandatory aspect of captive operations. Question 8. Topic: Taxation of captive insurance in Arkansas and federal tax treatment. Under IRS guidelines, which of the following would most likely be considered a valid business purpose for forming a captive insurance company rather than solely for tax avoidance? A. To defer taxes on company profits. B. To retain control over claims handling and risk management practices. C. To create a vehicle for aggressive investment strategies. D. To provide tax-free dividends to shareholders. Answer: B. Explanation. The IRS considers captives to have a legitimate business purpose if they are primarily used to manage risk and control claims practices, as in option B. This approach enhances the company's control over risk management and aligns with IRS requirements. Option A is incorrect, as captives cannot be formed purely to defer taxes. Option C is not a primary purpose of a captive and may lead to IRS scrutiny. Option D is also incorrect, as dividends are generally subject to tax and the IRS discourages captives that are primarily set up for tax avoidance. Question 9. Topic: Legal and regulatory framework for captive insurance in Arkansas. Which of the following best describes a unique aspect of the Arkansas regulatory environment for captive insurance companies? A. Arkansas captives are not required to submit any financial reports. B. The Arkansas Department of Insurance mandates an annual audit for all captive insurers. C. Arkansas captive insurers can operate without a license as long as they serve only parent company affiliates. D. Arkansas captives are allowed to provide direct coverage to external clients without restrictions. Answer. B. Explanation. In Arkansas, captive insurance companies are required to undergo annual audits, which help the Department of Insurance ensure compliance with state regulations and the captive solvency. Option A is incorrect, as captives must submit various financial reports. Option C is incorrect, because licensing is mandatory regardless of client affiliation. Option D is also incorrect, as Arkansas captives are generally limited in offering services directly to external clients without additional requirements. Question 10. Topic: Exit strategies and captive termination. If a captive insurance company in Arkansas decides to cease operations, which of the following should be a primary consideration during the termination process? A. Shifting all remaining risks to a newly formed entity without notifying the Arkansas Department of Insurance. B. Ensuring a proper runoff management strategy to handle outstanding claims and obligations. C. Transferring all assets to the parent company immediately without settling liabilities. D. Minimizing tax obligations by distributing all reserves to shareholders directly. Answer. B. Explanation. A well-planned runoff strategy is essential when terminating a captive to ensure that all claims and liabilities are addressed. This step protects policyholders and fulfills the captive's remaining obligations. Option A is incorrect, as regulatory notification is required. Option C is incorrect, since liabilities must be settled before asset distribution. Option D is also incorrect. Tax obligations must be handled in accordance with regulatory guidelines, and reserves must first cover all outstanding liabilities before shareholder distribution. Question 11. Topic: Formation and operation of captive insurance companies. When forming a captive insurance company in Arkansas, which of the following is the most critical component in the initial business plan for the captive? A. Determining the minimum capital and surplus required to meet regulatory standards. B. Creating a sales and marketing strategy for attracting third-party clients. C. Establishing a premium pricing model for all lines of coverage offered. D. Deciding the number of employees required to run the captive efficiently. Answer A. Explanation. When establishing a captive insurance company, the most crucial aspect of the business plan is ensuring that the required minimum capital and surplus meet regulatory standards. Arkansas, like other states, mandates a certain level of financial backing to ensure the captive can pay claims and remain solvent. Option B is incorrect, because most captives are formed to insure the parent company's risks, not to attract third-party clients. Option C is incorrect, as premium pricing follows risk assessment, which is part of the operational strategy but not a primary focus in the early planning stages. Option D is a consideration but secondary to financial readiness. Question 12. Topic: Reinsurance and alternative risk transfer. Which of the following reinsurance types would most likely be used by a captive insurer to limit its liability for large losses while maintaining risk retention? A. Facultative reinsurance. B. Excessive loss reinsurance. C. Quota share reinsurance. D. Surplus share reinsurance. Answer. B. Explanation. Excessive loss reinsurance is commonly used by captive insurers to limit their exposure to large catastrophic losses while retaining a certain level of risk. This allows the captive to protect itself from substantial claims without transferring too much of the risk. Option A is incorrect, because facultative reinsurance is usually bought for specific risks, not as a blanket protection for large losses. Option C is incorrect, because quota share reinsurance involves sharing premiums and losses proportionally, which may not be the best strategy for a captive seeking to limit large claims exposure. Option D is also not ideal for limiting large losses, as surplus share reinsurance involves sharing only the excess premiums and losses over a certain amount. Question 13. Topic: Financial aspects of captive insurance. Which of the following best describes the role of reserves in a captive insurance company's financial strategy? A. Reserves are used to invest in high-risk securities to maximize returns. B. Reserves ensure the captive has enough liquidity to pay future claims and meet regulatory requirements. C. Reserves are paid out to shareholders as dividends once they are accumulated. D. Reserves are not required in a captive, as the company can pay claims from its general operating funds. Answer: B. Explanation. Reserves are a critical part of a captive insurance company's financial strategy. They are set aside to ensure that the captive has the liquidity to pay for future claims and to meet any regulatory requirements. This helps maintain the solvency of the captive. Option A is incorrect because reserves should not be invested in high-risk securities, as they are meant to ensure liquidity for claims. Option C is incorrect because reserves cannot be paid out as dividends until claims and liabilities are fully covered. Option D is incorrect because reserves are a legal and financial requirement to ensure the captive can meet its obligations. Question 14. Topic: Legal and regulatory framework for captive insurance in Arkansas. Which of the following is true regarding the regulatory requirements for captive insurance companies operating in Arkansas? A. Captive insurance companies in Arkansas must file annual financial statements with the Arkansas Department of Insurance. B. Captive insurance companies in Arkansas are exempt from solvency requirements if they insure only the parent company. C. Captive insurers in Arkansas must have at least 10 policyholders to operate legally. D. The Arkansas Department of Insurance allows captives to operate without any external audit requirements. Answer A. Explanation. Captive insurance companies in Arkansas are required to file annual financial statements with the Arkansas Department of Insurance to ensure compliance with the state's insurance regulations and maintain solvency. Option B is incorrect, as captives are still subject to solvency requirements even if they only insure the parent company. Option C is incorrect, as Arkansas does not require a minimum number of policyholders for a captive to operate. Option D is also incorrect, as external audits are mandatory for regulatory oversight. Question 15. Topic: Captive insurance policies and coverage types. Which of the following would likely be excluded from coverage under a typical captive insurance policy? A. Property damage caused by natural disasters. B. The liability resulting from criminal acts by the insured. C. Employee injuries covered by workers' compensation insurance. D. Product liability claims arising from the insured's operations. Answer B. Explanation. Captive insurance policies typically exclude coverage for criminal acts, as this would be contrary to the purpose of the policy, which is to provide risk coverage for unforeseen and accidental events. Option A is incorrect, as many captives provide coverage for natural disaster-related property damage. Option C is incorrect because employee injuries covered by workers' compensation are usually outside the scope of captive insurance. Option D is incorrect, as product liability claims are commonly included in captive insurance coverage if they fall within the policy's terms. Question 16. Topic: Corporate governance and compliance for captive insurance. What is the primary responsibility of the board of directors for a captive insurance company in Arkansas? A. Overseeing day-to-day claims processing. B. Ensuring that the captive complies with all state and federal insurance regulations. C. Directly negotiating reinsurance contracts with external providers. D. Handling the sales and marketing of captive policies to external clients. Answer B. Explanation. The primary responsibility of the board of directors of a captive insurance company is to ensure that the captive complies with all state and federal insurance regulations, including those specific to Arkansas. This includes overseeing governance, financial practices, and ensuring that the captive is solvent and properly capitalized. Option A is incorrect, as claims processing is typically managed by third-party administrators. Option C is incorrect, as the board may provide oversight but does not usually directly negotiate reinsurance contracts. Option D is not a primary responsibility for most captives, which typically serve the parent companies and needs rather than marketing policies to external clients. Question 17. Topic: Taxation of captive insurance in Arkansas and federal tax treatment. How does the IRS typically view captives with respect to tax deductions for premiums paid by the parent company? A. Premiums paid to a captive are always fully deductible regardless of the risk retention strategy. B. Premiums paid to a captive may be deductible if the captive is primarily engaged in underwriting risks and operates at arm's length. C. Premiums paid to captives are only deductible if the captive provides coverage for third-party clients. D. The IRS does not allow any deductions for premiums paid to a captive insurance company. Answer B. Explanation. The IRS allows deductions for premiums paid to a captive insurance company if the captive is primarily engaged in underwriting risks and operates at arm's length. This means the captive must have a legitimate risk-sharing arrangement with the parent company and meet the IRS's standards for being a bona fide insurance company. Option A is incorrect because the IRS will not allow deductions if the captive does not meet the underwriting and operational criteria. Option C is incorrect as third-party coverage is not a requirement for premium deduction eligibility. Option D is incorrect as the IRS allows deductions if the captive meets the criteria for legitimate insurance. Question 18. Topic: Risk management and risk retention for captive insurance. What is the primary advantage of using a risk retention group? It's a form of captive insurance. A. RRGS allow for unlimited underwriting authority. B. RRGS can insure a broad range of commercial risks for external policyholders. C. RRGS allow members to share risks within a specific industry, often reducing costs for niche coverage. D. RRGS are exempt from regulatory requirements in Arkansas and other states. Answer C. Explanation. A risk retention group RRG allows its members to share risks within a specific industry or profession, often leading to reduced costs for specialized coverage. Its structure benefits companies that face similar risks. Option A is incorrect as RRGS are subject to certain underwriting limits and regulatory constraints. Option B is incorrect as RRGS typically only cover risks for their members, not external policyholders. Option D is incorrect as RRGS are still subject to regulatory requirements, including state laws. Question 19. Topic: Legal and regulatory framework for captive insurance in Arkansas. Which of the following is a requirement for a captive insurance company seeking to operate in Arkansas? A. The captive must insure at least 3 unrelated parties. B. The captive must demonstrate that its underwriting and risk management strategies are commercially viable. C. The captive must be owned by an external, unrelated insurer. D. The captive must conduct business solely within the state of Arkansas. Answer B. Explanation. To operate in Arkansas, a captive insurance company must demonstrate that its underwriting and risk management strategies are commercially viable. This ensures the company can meet its obligations and comply with state insurance regulations. Option A is incorrect because captives can insure the risks of their parent company, not necessarily unrelated parties. Option C is incorrect as captives do not need to be owned by an external, unrelated insurer. They are typically owned by the parent company that sets up the captive to insure its own risks. Option D is incorrect as captives can conduct business outside of Arkansas provided they comply with the regulatory requirements of other states where they operate. The key requirement is that the captive's underwriting and risk management strategies must be commercially viable to ensure the company is financially sound. Question 20. Topic: Operational aspects of captive insurance. Which of the following is typically the most significant challenge for a captive insurance company in its first few years of operation? A. Managing claims expenses for large catastrophic events. B. Maintaining compliance with evolving state and federal regulations. C. Generating a profit through external underwriting. D. Establishing a reputation in the commercial insurance market. Answer B. Explanation. One of the most significant challenges for a newly established captive insurance company is ensuring compliance with evolving state and federal regulations. As the captive begins operations, it must navigate complex legal and financial requirements which can vary across jurisdictions. Option A is incorrect because claim expenses may not be substantial early on, depending on the risks retained by the captive. Option C is incorrect as captives typically do not underwrite external business but focus on the risks of their parent company. Option D is also incorrect as captives are generally not focused on building a commercial market reputation but rather serving the needs of their parent company. Question 21. Topic: Captive insurance types. Which of the following is the most appropriate type of captive insurance for a group of businesses in the same industry looking to share risk? A. Single parent captive. B. Group captive. C. Risk retention group. D. Association captive. Answer B. Explanation. A group captive is the most appropriate structure for a group of businesses in the same industry seeking to share risks. These businesses pool their resources to create a captive that provides coverage for their collective risks. Option A is incorrect because a single parent captive is designed for a single entity to insure its own risks. Option C is incorrect as a risk retention group RRG is a type of captive that pools risks among members of the same industry but operates under different regulatory standards than a traditional group captive. Option D is incorrect because an association captive is typically for members of a trade or professional association, not specifically for businesses in the same industry. Question 22. Topic: Captive insurance operations and risk management. How can a captive insurance company in Arkansas manage its investment strategy while adhering to regulatory constraints? A. By investing in a broad portfolio of high-risk equities to maximize returns. B. By investing primarily in government securities and highly rated corporate bonds. C. By outsourcing all investment decisions to third-party managers with no oversight. D. By avoiding all investments and holding cash reserves only. Answer: B. Explanation. Captive insurance companies in Arkansas, like other insurers, are typically required to invest conservatively to maintain solvency and meet regulatory requirements. A strategy focusing on government securities and highly rated corporate bonds is common as it balances risk with the need for liquidity. Option A is incorrect because investing in high-risk equities can jeopardize the financial stability of the captive, especially in its early years. Option C is incorrect as the captive must maintain oversight and be actively involved in investment decisions. Option D is incorrect because holding cash reserves alone would not generate sufficient returns to meet the captive's financial obligations. Question 23. Topic: Taxation of captive insurance. What tax advantage is most often associated with forming a captive insurance company? A. Premiums paid to the captive are not deductible for tax purposes. B. The captive can pay dividends to shareholders that are tax-free. C. The parent company can deduct premiums paid to the captive as a business expense. D. The captive itself is exempt from paying taxes on its income. Answer: C. Explanation. The primary tax advantage for a parent company that forms a captive insurance company is that the premiums paid to the captive are generally deductible as a business expense, which reduces the taxable income of the parent. Option A is incorrect because premiums paid to the captive can be deductible, provided the captive meets regulatory requirements. Option B is incorrect because dividends paid by the captive to its shareholders are not typically tax-free. Option D is incorrect because the captive itself is subject to taxation and it must pay taxes on its income just like any other insurance company. Question 24. Topic: Risk management strategies for captives. What is the primary purpose of a loss prevention program in a captive insurance company? A. To reduce the cost of premiums by minimizing risk exposure. B. To help the captive gain approval from regulatory bodies. C. To provide financial incentives for shareholders of the captive. D. To generate additional income through investment returns. Answer A. Explanation. The primary purpose of a loss prevention program is to reduce the cost of premiums by minimizing the risk exposure of the captive. Effective risk management strategies, such as safety programs, can reduce the frequency and severity of claims, leading to lower premiums over time. Option B is incorrect because while loss prevention programs are part of regulatory compliance, their main goal is risk reduction, not regulatory approval. Option C is incorrect as loss prevention does not directly provide financial incentives for shareholders. Option D is incorrect as loss prevention is focused on risk mitigation, not investment income. Question 25. Topic: Solvency and capitalization of captive insurance. Which of the following is true regarding the capital requirements for a captive insurance company in Arkansas? A. Captive insurance companies are exempt from capital requirements if they insure only the parent company. B. Captive insurance companies must meet specific capital and surplus requirements based on the type of coverage they provide. C. The capital requirements for a captive are determined solely by the parent company's financial standing. D. Arkansas does not impose any capital requirements on captive insurance companies. Answer B. Explanation. Captive insurance companies in Arkansas must meet specific capital and surplus requirements based on the type of coverage they provide and the risk profile of their operations. These requirements are set to ensure that the captive has sufficient financial resources to pay claims and remain solvent. Option A is incorrect because captives are still subject to capital requirements even if they only insure the parent company. Option C is incorrect because the capital requirements are determined by regulatory standards, not solely by the parent company's financial standing. Option D is incorrect because Arkansas does impose capital requirements on captives. Question 26. Topic: Financial aspects of captive insurance. Which of the following would be the most significant consideration for a captive insurance company when determining the amount of capital and surplus it needs to maintain? A. The risk appetite of the parent company. B. The potential profit margins from underwriting. C. The regulatory requirements for reinsurance. D. The expected claims frequency and severity for the covered risks. Answer D. Explanation. The most significant consideration for determining the capital and surplus requirements for a captive is the expected claims frequency and severity of the risks the captive covers. This will help ensure that the captive has enough financial resources to meet potential claim payouts while maintaining solvency. Option A is incorrect because while the risk appetite of the parent is relevant, the primary concern is ensuring adequate funds to cover claims. Option B is incorrect, as underwriting profit alone doesn't dictate the capital and surplus needed. The focus should be on risk exposure. Option C is incorrect because reinsurance affects the transfer of risk, but the captive still needs sufficient capital to meet its own obligations before considering reinsurance. Question 27. Topic: Formation and operation of captive insurance companies. What is the most critical step in the formation of a captive insurance company? A. Determining the type of coverage to be offered. B. Filing a business plan with the Arkansas Department of Insurance. C. Selecting a fronting insurer for the captive. D. Performing a feasibility study to assess the financial viability of the captive. Answer D. Explanation. The most critical step in the formation of a captive insurance company is performing a feasibility study. This study evaluates whether forming a captive is financially viable, considering the risks to be insured, the potential savings on premiums, and the capital and surplus requirements. Option A is incorrect because determining the coverage type comes after the feasibility study has shown that forming the captive is a viable option. Option B is incorrect because the business plan is important but comes after the feasibility study. Option C is incorrect because while selecting a fronting insurer may be part of the process, it is not as critical as assessing the overall feasibility of the captive. Question 28. Topic: Reinsurance and alternative risk transfer. How does the use of reinsurance benefit a captive insurance company? A. It transfers some of the risk to a third party, reducing the captive's exposure to large claims. B. It eliminates the need for capital and surplus reserves for the captive. C. It increases the regulatory burden on the captive. D. It allows the captive to offer policies to unrelated third-party entities. Answer A. Explanation. Reinsurance allows a captive insurance company to transfer a portion of its risk to a third party, which reduces the captive's exposure to large claims. This helps the captive maintain financial stability by spreading risk. Option B is incorrect because the captive still needs capital and surplus reserves regardless of its use of reinsurance. Option C is incorrect because reinsurance generally does not increase regulatory burdens but rather helps manage risk. Option D is incorrect because a captive insures its own risks, not those of unrelated third-party entities, unless it forms a group captive or risk retention group. Question 29. Topic: Risk management and risk retention for captive insurance. What is the primary advantage of using a captive insurance company for managing risk retention? A. Captives eliminate the need for insurance premiums entirely. B. Captives provide the parent company with more control over its insurance policies and claims handling. C. Captives are exempt from any regulatory oversight by the state. D. Captives allow the parent company to diversify its investments outside the insurance sector. Answer B. Explanation. The primary advantage of using a captive insurance company is that it allows the parent company more control over its insurance policies, claims handling, and risk management strategies. Captives enable businesses to tailor their coverage to their specific needs and have greater oversight of claims processes. Option A is incorrect because captives do not eliminate insurance premiums as they replace traditional commercial insurance premiums with premiums paid to the captive. Option C is incorrect because captives are still subject to regulatory oversight by the state insurance department. Option D is incorrect because while captives allow for investment management, their primary function is risk retention, not investment diversification. Question 30. Topic: Corporate governance and compliance for captive insurance. Which of the following is a primary responsibility of the board of directors for a captive insurance company in Arkansas? A. Determining the level of capital and surplus required for solvency. B. Developing marketing strategies to sell policies to external clients. C. Managing the investment portfolio of the captive's assets. D. Ensuring compliance with state and federal insurance regulations. Answer D. Explanation. The primary responsibility of the board of directors for a captive insurance company is ensuring compliance with state and federal insurance regulations. This includes ensuring that the captive meets all necessary licensing, reporting, and financial requirements. Option A is incorrect because the board may provide oversight on capital requirements, but the actuaries and financial experts usually determine this. Option B is incorrect because captives do not typically sell policies to external clients. They provide insurance coverage for the parent company. Option C is incorrect because while the board may oversee the investment strategy, the actual management of the investment portfolio is usually delegated to financial professionals or managers.